Hello everyone, welcome to iExamB. In continuation with our series for professional knowledge topics discussion for Bank of India Credit Officer, today we are going to discuss about the Basel Norms. The Basel Accord is a set of global voluntary regulatory framework for banking supervision to ensure financial stability. So all the countries in the globe together came up for certain regulations that the banking industry should follow, because banking industry in every country is very essential to ensure the financial stability. So these accords or norms are actually framed by a committee which is known as the Basel Committee on Banking Supervisions, BCBS, in case the full form is asked, you should be knowing. And this is headquartered at the Bank for International Settlements in Basel, Switzerland, hence the name Basel Norms. Until date, this committee has released 3 Basel Accords known as Basel I, Basel II and Basel III. Currently, Basel III is applicable in various countries. So when the Basel Accords and norms were formed, there were 3 pillars that formed the foundation which ensured that there is good banking practices being followed globally. The first pillar relates to minimum capital requirement, that the bank should be adequately funded and capital they should have so as to bear the different kinds of risk that they engage in. So this deals with the minimum regulatory capital that the bank should have, keeping in mind the major 3 risks that they face. One is the credit risk, the market risk and the operational risk. The second pillar is the supervisory review process. What this means is that in order to ensure that the banks are well capitalized and given the risks that they are facing, there should be regular rules, regulations that are provided by the central bank of a country. In our case, it is the Reserve Bank of India or RBI, and that there is proper supervision happening from the regulator, right? So regulatory framework in India for banks is given by RBI, which is known as the Internal Capital Adequacy Assessment Process, and RBI also carries out supervision on a regular basis to ensure that. The third pillar is the market discipline. Basically, this is supporting the first and the second pillar and ensuring there is transparency in the way the banks are functioning and reporting, so that there are adequate disclosures being made and sound banking practices being followed by the banks. Now let's look at the elements that are there in the Basel III norms which the banks have to follow. The first element relates to the core equity, right? So there are stricter norms that were brought in under the Basel III norms to ensure that the banks have adequate core equity. This is the purest form of equity which the banks should maintain. Over and above their core equity, there was a concept of CCB, or the capital conservation buffer, that was brought in under Basel III norms. This was an additional layer of common equity that was brought in to ensure that the banks during good times create more buffers so that these can be held in times of stress. The third element related to capital was the counter-cyclical capital buffer. So this is a voluntary buffer. This is not mandatory. CCB is a mandatory buffer, but this is a voluntary buffer which the central bank of a country decides when to impose or not to impose on the banking industry in their country. This buffer is basically to overcome any systemic risks or system-wide risks that the banks may face because of credit booms happening in the economy or globally. And then Basel III norms, very important aspect that was identified was the liquidity risk which the banks face, and therefore in line with the liquidity risk, there were 2 ratios that were introduced in the Basel III norms. One was related to your LCR and NSFR. LCR stands for liquidity coverage ratio and NSFR stands for net stable funding ratio. So these 2 ratios were introduced. Your LCR was related to short term liquidity and your NSFR was related to your long term liquidity. And one more ratio was introduced was the leverage ratio. The leverage ratio was also introduced to ensure that the minimum amount of loss absorbing capital relative to a bank's assets and off balance sheet exposure is maintained. So these were the five key elements that were brought out under the Basel III norms. Before we move ahead, I would like to tell you about the Bank of India Credit Officer online course at iExamB. As of now is available at a flat 60% offer, which you can avail by using the coupon code BOI60. You can also try the demo of the course before buying for free on our website. Let's move on to understand the concept of CAR or CRAR. CAR stands for Capital Adequacy Ratio, and the other terminology used for this is also CRAR, which stands for Capital to Risk Weighted Assets Ratio. Under Basel norms, when we say minimum capital requirement, basically banks have to maintain a minimum capital adequacy ratio, which is calculated as your tier 1 capital and your tier 2 capital divided by the risk weighted assets. So these are the risk weighted, RWA stands for risk weighted assets. What is tier 1? Tier 1 capital is your purest form of capital which has the loss absorbing capacity. It is also known as the going concern capital because this is the capital which remains till the company is going on or exists, and it has two components, your core capital and your AT1, which is your additional tier 1 capital. Your tier 2 capital is the supplementary capital, which can absorb losses but only in the case of usually liquidation of the bank. Therefore, it is also known as the gone concern capital, or it is also known as the supplementary capital. It basically has 5 elements. It is basically your undisclosed reserves, revaluation reserve, then your hybrid debt, subordinated debt, and general provisions made against certain assets to an extent limit that has been specified. And your risk weighted assets are basically the assets of the bank, your loan book and various other assets adjusted for the risk that those assets are carrying, because we are trying to find the capital that the bank should have in relation to the risks that they carry on their books. So what are the minimum capital requirements? We are more concerned about this in India. RBI has made it a little more stringent than the Basel norms internationally available. Our tier 1 capital should be 7%, which is a combination of your core equity of 5.5% and additional tier 1 capital of 1.5%. When we add tier 2 capital to it of 2%, we actually get the minimum CAR requirement of 9%, including the mandatory CCB, capital conservation buffer of 2.5%. The total that the Indian banks have to maintain is 11.5%. And then there was a counter cyclical capital buffer also that we had talked about. That is as of now currently standing at 0. So this is something voluntary which the central bank, so in our case Reserve Bank of India, decides whether to implement or not. As of now, RBI has not implemented. The difference between Basel norms and India norms as stated by RBI is the difference between the minimum core equity. So RBI has stated it as 1% higher than what the Basel norms require. So we have following a more stringent approach. Let's now move on to the question and answers. Basel III capital regulations are based on certain mutually reinforcing pillars. So we talked about the 3 pillars. Which of the following is not one of them? Is it the minimum capital standards, supervisory review of capital adequacy, risk management and market discipline, liquidity standards, or none of the above? The correct answer is liquidity standards. The pillars are these 3. However, within Basel III, liquidity standards were introduced, but that is not a pillar. So that is a difference. Okay, it is not a pillar. Pillar are only 3. What does C in LCR stand for? So LCR, I was telling, is one of the liquidity, short-term liquidity monitoring ratio that was introduced under Basel III. What does C stand for? Correct answer is coverage. Liquidity coverage ratio. It helps to find the short-term liquidity of the bank, that ensure that there is short-term liquidity. Certain high quality liquid assets are taken to and checked whether a bank can survive acute stress if it lasts for 30 days. So for 30 days there should be high quality liquid assets that the bank should maintain, that helps it to tide over any stress for over a month, and this has to be maintained at 100%. At iExamB, you will find free mock test for various exams, 100+ exams. So you don't need to buy mock test. At iExamB, you will file all of them, quality mock test for free for your preparation of various government job exams. Third question, as per the Basel III implementation in India, what is the minimum tier 1 capital that must be maintained by the banks on an ongoing basis? We had discussed this. I hope all of you remember. The correct answer is 7. So in the exam, if such questions come, please cross check whether it is asking for Basel norms or for India. So here we are asking for India. In that case, it will be 7. If it was asking what Basel norms, Basel III norms suggest, in that case the answer would have been 6%. Next question, in terms of banking capital reserve, tier 2's capital loss absorption capacity is higher than tier 1, lower than tier 1, equal to tier 1, equal to or higher than tier 1, or equal to or lower than tier 1 capital. The correct answer is lower than. As we were discussing, tier 1 is your purest form of capital. It is the going concern capital. However, tier 2 capital is your gone concern capital. It will be able to absorb loss in the event of liquidation only. The last question for today, Basel III was introduced, one of the ratios to mitigate the liquidity mismatches in the long term for banks. Which of the following is that particular metric? Please give your answers in the comments box. Thank you everybody for watching. At iExamB, we are conducting live classes for the Bank of India and PNB Credit Officer course. You can see the schedule of the ongoing classes on your screen. If you want to avail the offer in the course, currently we are running a 60% off on a Bank of India Credit Officer course. For any more details, you can reach out on the number mentioned on the screen. These classes and the content and the mock test and the practice test provided are made by expert faculties for professional knowledge, English language and general awareness. Thank you everybody. All the best for your preparation. Don't forget to subscribe to the channel.